I'm Sarah, a tutor at Accountancy Learning, and in this video I'll take you through the Tax Processes for Business, Finance Act 23, AAT Sample Paper 2, Task 1. So this task is about understanding and calculating UK tax laws relating to VAT, registration and deregistration and special schemes. It contains parts A to D. So firstly then, a VAT registered trader sold an item to a VAT registered retailer for 1,500 plus VAT of 300. The retailer sold the item for 2,300 plus VAT of 460 to a non-VAT registered business. Now we've got to complete the following statements. The VAT registered trader who sold the item for 1,500 plus VAT will include VAT of, and we've got to select an amount, as a cost to its business. So the options that we've got for our drop downs are over here. So when a VAT registered trader sells an item for 1,500 plus VAT, they are not going to be including any VAT as a cost to the business. So the answer for that one is going to be 0. The VAT isn't a cost to that business. All the VAT registered trader will have to do is pay that VAT over to HMRC. So it's just a liability. They've collected it from the person they've sold it to or from the business they've sold it to, and they're going to pay that on to HMRC. So there is no cost to the business involved. The second one, the VAT registered trader who purchased the item for 1,500 plus VAT and sold the item for 2,300 plus VAT will include VAT of, and we've got to choose an amount, as a cost to its business. So again, they have purchased the item, but because they're VAT registered, they're going to claim back that VAT amount. So that amount of the £300 that they've paid to purchase that item, they will claim that back on their VAT return. And likewise, when they've sold the item onwards, it means that that will be a liability. So again, there is no cost to that VAT registered trader who bought the item and then sold it on. So the cost of buying that item is 1,500. They've paid 1,800, but £300 of that they will claim back from HMRC on their VAT return. Then finally, the non-VAT registered business who purchased the item for 2,300 plus VAT will include VAT of as a cost to its business. So the key bit here then is the non-VAT registered business. So it means they have to pay the full amount. So the gross amount will be 2,300 multiplied by 1.2 to give us the gross amount, which would be 2,760. So this is the amount that will go into their profit or loss, their statement of profit or loss, because they can't claim that amount back. So the VAT amount that's going to be included as a cost will be 2,300 multiplied by 0.2, or you can multiply it by 20%, whichever way you'd like to do it. And then that gives us our answer of £460. Next, identify which one of the following businesses may register voluntarily for VAT. So we're given 3 businesses. So business providing taxable services with an annual turnover of 105,000. A business making wholly zero rated supplies with an annual turnover of 78,000. And then a business making a mixture of standard and zero rated supplies. The annual turnover from standard rated supplies is 65,000 and from zero rated supplies is 30,000. So we will have a look at the reference material for this question, because we can have a look at the registration threshold. So 85,000 is when businesses have to register for VAT. But we're talking about when they may register voluntarily for VAT. So the first one is 105,000. So taxable services, annual turnover 105. Well, they would have to register for VAT because of the £85,000 registration threshold. So that wouldn't be voluntary. A business making wholly zero rated supplies with an annual turnover of 78,000. So that's below our registration threshold. And because they're making zero rated supplies only, it means they won't have to pay any VAT to HMRC, but they will be able to claim back if they register on all of the purchases to make those supplies. So that is going to be our answer, that they can voluntarily register for VAT. Just to look at the last one though, a business making a mixture of standard and zero rated supplies, and we've got 65,000 standard rating and 30,000 zero rated. Well, they have a total of 95,000. So that would be higher than the 85,000 registration threshold. So they would have to register for VAT. And again, it wouldn't be voluntary. So next, the following three businesses operate special VAT schemes. So we've got A Limited has been operating the cash accounting scheme for several years. B Limited is a limited cost business and registered for VAT 3 months ago under the flat rate scheme. And C Limited has been operating the flat rate scheme for 3 years and is not a limited cost business. So let's look at the statements here. So A Limited does not pay VAT to HMRC until money has been received from their customers. So A Limited is on the cash accounting scheme, which means that we don't pay HMRC any VAT until we actually have the money. So we don't do it on invoicing, we wait until we've got the money from customers. So that is going to make this answer true. B Limited pays VAT on its gross turnover at a rate of 19%. So B Limited, we're told, is a limited cost business and it registered for VAT 3 months ago under the flat rate scheme. So for the rest of this question, we can use our reference material from section 15. So I'll bring up a snippet that will help us here. So this is from reference material 15. And our statement is B Limited pays VAT on its gross turnover at a rate of 19%. But as a limited cost business, we can see that the rate is 16.5%. So we can take that one as false. Next then, C Limited has bought one item of equipment which includes £500 of VAT at the standard rate. C Limited can recover the input VAT paid. So for that one, we are going to look at another part of reference material 15. And it says here that input tax can be recovered on individual large capital purchases up to 2,000. So that will make this statement true. And then the final statement is both B Limited and C Limited are currently entitled to the 1% flat rate discount. So again, in the same lot of reference material, you will be able to see this section. So the discount in first year of being VAT registered is 1%. So let's have a look at the information. B was registered 3 months ago, but C Limited has been registered for 3 years. So it's only B that would be entitled to the discount. So that would be false. Daisy Property Limited's PLC has been operating the annual accounting scheme for several years. The taxable turnover for the next financial year ending the 31st of March 2024 is shown in the following table. And there you can see we have got all of the figures up to March 2024. Remember, in the exam, you can bring that up by using the references section on the right-hand side, so you can see both question and information. So part D is then identify the date that Daisy Properties PLC must withdraw from the annual accounting scheme. So we are going to look at some reference material once again. So, leaving the scheme for annual accounting. It says it's compulsory if taxable turnover at the end of VAT accounting year exceeds the threshold, which is at 1.6 million. Now, the important part in this is to make sure that you're looking at the end of the VAT accounting year. So when we look at our question, the next financial year ending the 31st of March 2024, so that's our end of our accounting year, we can see that we're going to exceed it in December. There's our 1.7 million. However, because it's compulsory at the end of the accounting year, you're going to be looking at March 2024 is when they must leave the scheme. So our answer for that question will be 31st of March 2024. And that completes task 1.